All right, so when we have talked about valuation so far, we've talked about using the Modigliani-Miller model to help us do a cash flow valuation of the firm. And what we want to do is a parallel process. And what's important about the parallel process is that however we value the firm, we still have to come up with the same answer. So the parallel process is really working backwards. So when we do a cash flow valuation of a company, we're predicting the cash flows, and based on the cash flow predictions, that will infer a share price. And that's what we did in the model that we built. When we do multiples, or what are often called comparables or comps analysis, then what we do is we have the price. We know the price of the firm, okay, especially if it's publicly traded. And what we want to do is work backwards to figure out what the cash flows are. So really, a multiple analysis, the cash flow price has to equal the cash flows the firm generates. They eventually have to be the same. So that's why I said it's really just a parallel way of doing valuation. It's a more simplified way, but it's based on actual prices in the marketplace. And so basically, to do a multiples or comparables or comparables, however you want to define the word, analysis of a company, one of the things you have to do is you have to look at the market prices for similar assets to help you do your valuation. So what I like to say is the most common multiple that you're probably already familiar with is if you've ever bought or sold a house. It's the appraisal process used in a house is completely based on a multiples-based approach. So the way that the appraiser would work is they'll say, okay, say you put your house on the market for sale. They'll come in and they'll look in the last 6 months at similar houses in nearby neighborhoods. And they'll say, here's the price that these houses have sold for, that actually sales. And then they'll look at here's how much square foot these houses had that were sold. And then they'll take the price and they'll divide by the square foot. And that will get them a price per square foot. So what the appraiser really will do is they'll get a price per square foot of similar types houses to yours. And then they'll say, how many square feet do you have? They'll multiply by that price per square foot, and that will become the appraised value of your house. Right? Now, they will make some adjustments to the price per square foot. What types of things do you think would lead to an adjustment? Just kind of following with this metaphor. Yeah.
Number of bedrooms, bathrooms.
Numbers of beds and baths. That might raise or lower the price per square foot a little bit. What else?
Condition.
The condition of the house. That could also have an influence. What's another factor?
Lot size.
Lot size. Are you on a quarter of an acre lot? Are you on a third of an acre lot? Are you an acre lot? So what is the lot size, assuming it's not a condo? Location. Are you on a cul-de-sac? Are you on a lake? Are you on the middle of a street? Are you in a busy intersection that other people aren't going to look at? That could affect it.
When the house was built.
The age of the house. What is the age of the house? And, does the house have any physical problems or defects associated with it? Does it have a leaky roof, for example? Right? So the point is that they'll make some adjustments to the multiples, but they'll have a general idea based on the multiples. Not a perfect approach, but that's the way that we would do it. So I want you to think about a price to earnings ratio or an enterprise value to EBITDA ratio in the same manner. Okay? So what we do is we look at similar companies instead of similar houses. We look what they're trading at, and then we make adjustments based on factors that affect the multiple. In our case, and this was already on your midterm exam, the growth rate, the ROIC, the cost of the capital, the non-operating items, the tax rate, and the capital structure. Those are the factors that influence the multiples. Okay? And so when we do a multiple analysis, that's the idea, is that there's kind of like a price that firms would trade at based on what their peers are, and then we'll adjust the price up or down based on what those factors do for multiples. Right? So, to continue, the challenge with multiples is the benefit of the multiples. Multiples are easy, right? Because they're based on observed data, and what it does is it consolidates all of the financial numbers down to one. price to earnings, PE. All right, but that's the challenge because it's an oversimplification of everything about the firm in one ratio. Okay, so the advantage of multiples is it's one ratio. It's easy. The disadvantage is that we're really oversimplifying a lot of nuances down to one of these ratios. And we're making some compromises because we don't really have granularity. We're just putting it all into one number. So that's the advantage and the disadvantage of the multiple-based approach. So that if companies have drastically different growth rates, ROIC, capital structures, etc., then that can distort the multiples that we use for the company itself. So how do we actually do a multiples analysis, right? So these are the steps that you would perform. First, you have to select a range of companies that do similar things. And as simple as this sounds, this is the hardest part of multiples. Because in the real world, finding two companies that actually do the same things in the same way is really, really hard to do. Okay, so when we try and find peers, the definition of peers becomes a little distorted, right? But nonetheless, we'll have to make some compromises. But ideally, you want to find similar companies and at a similar stage. So for example, if I'm valuing Yahoo, because they were in the news today, in fact, why was Yahoo in the news today? Yeah, Yahoo hired Katie Couric to be the face of Yahoo. And it's not the first hire they've made. They've actually hired a number of people recently, kind of personalities, and they're trying to turn themselves essentially into a broadcast network that just happens to broadcast over the internet. And they think that that is one of the remakings of Yahoo, that their CEO, who came from Google, is actually trying to redo the network. So they're trying to become more like a Netflix, but more relevant to news and other entertainment in addition to just movies, and essentially become more of an online property. But so long story short, we wouldn't want to compare Yahoo with Snapchat, right? So when we try to figure out what the value of Snapchat, and we kind of joked about that last week, Snapchat has been around for 18 months. They don't have any revenue. You know, they're an online property, but it's hard to really compare a more established firm with Yahoo, and they don't really do the same thing. So then you can say, well, gee, I'd compare Snapchat with Facebook. But again, they're at different stages because Facebook is an established company with real revenue. Snapchat has not said how they plan on making revenue at all in the future. So even that type of comparison gets harder to make, even though we'll sometimes make that for comparative purposes. Yes?
This week I read a story about the Snapchat multiple. So the multiple they had used was the number of users or the number of Snapchats that went through, but it wasn't the amount of the senders that sent Snapchats, it was the amount of receivers. So they valued their user base as people who actually receive Snapchats, which is a little bit unfair because one person can send 10 pictures to 10 people and that artificially
inflates the amount of users.
Yeah.
And then we have to also assume that those users would then generate revenue for Snapchat, which is another leap of logic. So that if you just send it to somebody else that, then that's a receiver, and then suddenly they're going to spend $10 per, because I think there are 350 million under that metric, that suddenly 350 million people will spend $10 each to generate, or $100 each. Is that right? 10, 3.5, $10 each to generate, and that will all be profit. So like I said, that's an example of a multiple analysis. But finding peer companies, as simple as it sounds, and it's nice when Harvard Business School does a case study on this, right? Because in the case study, they've carefully chosen the companies and all of the profiles. It's much messier in the real world. We're going to get into that tonight. Second, we got to get the data. And specifically what we're going to need for the multiples is forward data. Because companies are based on expected cash flows in the future, then we care more about forecasted earnings and forecasted multiples than current multiples. That's why you can't do a real multiple analysis on Yahoo Finance or Google Finance, because we care about the enterprise value to expected earnings, not to the enterprise value on historical earnings. Same thing, price to earnings. We care about the expected earnings per share, not the historical earnings per share, because we care about the expected cash flows. So that's why you need to use a professional data service like Thomson One, CapIQ, or Bloomberg to get the full data to do the forward multiples. Third, you got to calculate the market multiples for the companies and then get an average. And then that average gives you a benchmark. And then from there, we try and do some interpretation of this to figure out ranges of valuation. So the other side of the story is I had one of my undergrad students who was at my TA last semester came back and she talked to the undergrad class about what her job is as an analyst. And she works for a small firm in the DC area that helps small companies value themselves. And basically what she said, and I can probably see if I can make this available online if you guys want to see what she said she did. But she was talking about valuing a small company. And she said what she does is she goes into Cap IQ, she screens out similar companies, she figures out their multiples. They apply an average multiple for that company, or sorry, for that industry to that company. And that's how they say how much a private company would be worth if they were publicly traded based on the multiples of the average publicly traded companies. And then they actually do a little bit of a liquidity discount to the private company to say, look, you're not public, so you're harder to sell, so you're probably not going to sell at the same price as a public company. So they have some liquidity discount, and that's how they do a valuation. And by the way, they're hired by companies to defend to the IRS all the time market valuations of private companies. But again, what's key to their analysis is they use a multiples-based approach. All right, and by the way, if you do an acquisition, you can do the same thing. If you do an acquisition, you're going to look at what other companies have been acquired for, what kind of premiums, and those premiums will infer a multiple. And so then you use those multiples to justify the acquisition premiums for other acquisitions. So multiples can be used in many different ways. And so that's what we'll do once we get the analysis. Now, best practices for multiples. Number one, ideally you want to have companies that have similar ROIC and growth rates. That's why, for example, you don't want to use a pure startup against a mature company. They're just going to have completely different profiles for growth and ROIC, so they're not as comparable. Second, you want to use forward-looking numbers. Third, you want to use numbers that help you predict the free cash flow. And EBITDA is probably one of the better predictors of free cash flow. So enterprise value to EBITDA is more commonly used for established companies. But it depends. Sometimes it's enterprise value to EBIT. Sometimes it's PE. So what you really start to find is that in industries, the analysts tend to kind of gravitate towards one multiple is more important for that industry. You got to figure out which multiple is really important for that industry. For example, if you're doing a Snapchat, they don't have EBITDA. They have no profits. So that's why they go enterprise value to sales, right? But we'd look at the appropriate multiple. And then we need to make some adjustments. And then we'll use the non-operating excess cash, leases, stock options, pensions to make adjustments to the multiples up or down that could affect the ultimate value of the firm. So if you remember our key value drivers equation, our key value drivers equation infers multiples. So what this table does is, if you remember our key value drivers equation, and I will quickly recreate it here in Excel. We said that for a company, we'll call it company A, the key value drivers were profit, or in our case, no pat or no plat. Right? But I'm just going to call that, for simplicity, profit. Growth, return on invested capital, and the cost of the capital, or the risk of the company, and that would have gotten the value of the firm, or in our case, the operating value. And the example we had previously used is, what if you had a company that had $100 million of profit, a 5% G, or sustainable growth rate into the long term? What if they had a 10% ROIC? And what if they had a 10% cost of capital? And we said, applying the key value drivers equation of profit times 1 minus the growth divided by the ROIC, and dividing that by the cost of capital minus the growth rate, that would say that that firm would be worth $1 billion. And for multiple, all to pull, can't spell today, this company would trade at a value to profit ratio of 10. Okay? That was the simple concept we had previously introduced. Well, that's what this table is based on. If you take this table and you run it through the key value drivers equation, assuming a 10% cost of capital, $100 million or $100 of no pat or no plat after tax profit, at this different levels of ROIC and this different growth rate, here's the answers. So if I change ROIC from 10% to 12%, and I guess I got kicked off the internet here. Okay, and these one decimal place. But basically you can see that 1167 would be 5% growth and 12% ROIC. That's the number right there. Okay, so all I've done is just taken this little simulation and I've just put it in a table. Right? Now, before I do, just as a reminder, why do these values stay at 1,000 all the way down this column? Yeah.
Cost of capital equals
That's right. Cost of capital equals the ROIC. We got a zero spread, so growth doesn't matter. Right? Which also means, why do those values get bigger as you go down here to the bottom right? Why is the number down here the biggest?
growth accelerating growth and value.
Yeah, the growth is accelerating the growth in the value with growth and high spread. So growth and high spread creates a lot of value. And conversely, when we have a negative spread, the faster you grow, the less you're worth. Right? So all I'm going to do on the next page is I'm going to take this table, and if I have 100 of no pat, which is my profit after tax, and just assume I had a 35% pre-tax, 35% profit rate, 35% tax rate, then my pre-tax profit, my EBIT, would be 154. Okay, I'm just adding in the 35% of taxes. So 154 pre-tax is 100 after tax at a 35% tax rate, which is the U.S. corporate tax rate that no corporation actually pays. So back to this. If I take this operating value, the result of the key value drivers equation, and I divide by that EBIT number, I get this multiple called enterprise value to EBIT. That's the multiple. So why is the enterprise value to EBIT multiple the same down this column? I'm sorry?
Zero spread.
Exactly. I have a zero spread. But what it says is that at this level of return and growth, I'm worth 6.5 times my EBIT. Okay? Now, what's down here? Why is this company down here trading, if it had these numbers, at 8.9 versus a company that traded at a 6.5 multiple? What's the difference between an 8.9 multiple and a 6.5 multiple? Spread and growth. So it goes back to, what are the drivers of multiple? Assuming peers, most peers should have a very similar cost of capital. Okay, so you start to notice we use a lot of assumptions when we do multiple analysis. And so one of the assumptions we make is that the peers have similar risks. So therefore, cost of capital is not the differentiating factor. So if we go back to our equation, if we take out cost of capital, what are the differentiating factors? They're growth and ROIC. So multiples are primarily an expression of growth and ROIC, unless the tax rates are different. So if one company pays a 35% tax rate and another company pays a 10% tax rate, then that would also affect the multiple. So we assume peers have similar tax rates. Right? They're in the same industry, should probably have similar tax rate, unless they have a bunch of non-operating items. One company's got a hoard of cash in the bank and the other company has no cash in the bank. That's going to distort their multiple, the one that has the hoard of cash. So again, we assume that companies don't have that much difference in non-operating items. right? So if the cost of capitals and the capital structures are about the same, if the tax rates are about the same, and the non-operating items are about the same, the real differentiator in multiples is growth in ROIC. So to keep it simple, when we think about multiples, multiples are really an expression of growth in ROIC, right? Now they're an expression of more than that, but typically we're assuming that there's not that much of a difference from peers. So if there is a difference, it's either the growth or ROIC differences, or it's one of those other factors. And that's the nuance of multiple analysis, because if the growth and ROICs are the same, then it's the other factors. If the other factors aren't there, then it's just the growth and ROIC. If the growth and ROIC is different and the other factors are different, good luck with your analysis, right? Because then you get a 6-factor analysis, and it becomes really hard to explain the multiple for the company. That's why, for example, price to earnings, which is the most commonly quoted multiple in a newspaper, is actually the most difficult ratio to explain, because price divided by earnings is earnings per share, which is based on net income, which is affected by everything. Because net income is after all the expenses. So the non-operating items, the tax rate, the capital structure, which affects interest rates, as well as the operating profits and the EBITDA, all affect the PE ratio. So PE is the most simple ratio for everybody to intuitively understand, but believe it or not, it's actually one of the harder ratios to explain, because all of the factors influence net income, influence the PE ratio. And so therefore, professionals prefer enterprise value ratios, because the enterprise value ratios, which generally stop at EBITDA and EBIT, the operating items, are less sensitive to changes in those non-operating items. They're less sensitive to changes in capital structure. They're less sensitive to changes in tax rate. They're less sensitive to the non-operating gains and losses, right? So therefore, the pros actually like the enterprise value ratios, but they'll still talk PE because that's used in the market. But in this class, what I'm going to make you responsible for are 6 ratios. And you can see that 3 of the enterprise value multiples, if I expand our spreadsheet, are actually here on this page. So here's the same enterprise values. Here's the EV to multiple, EV to EBIT, EV to EBITDA, EV to sales. So in this class, there are going to be 6 multiples you need to know. One is the price to earnings ratio. Share price divided by earnings per share. That basically tells you how much am I willing to pay for $1 of earnings per share. Okay, so if I have a PE of 10, it means for every $1 of earnings per share you generate, I'm willing to pay you $10 of price for that. If I have a PE of 15, then for $1 of earnings per share, I'm willing to pay you more. I'm willing to pay you $15 for every $1 of earnings per share. Okay, so higher PEs are generally perceived as better by investors because it means you're generating more value for me out of every $1 of earnings. Next, we have what's called the PEG ratio, where price to earnings says how much am I willing to pay for every $1 of earnings per share. The PEG ratio says how much am I willing to pay for every $1 of earnings per share growth. Okay, so the PE is what am I willing to pay absolutely for your earnings. The PEG is what am I willing to pay for the growth. Okay, so if my PEG ratio, which is defined as the PE divided by the growth rate, the long-term growth rate in earnings per share, if my PEG ratio is 1, that means for every $1 of earnings growth, I say that's worth $1. Okay, so I'm giving you $1 for every $1 of earnings growth in terms of valuation. If my PEG ratio is 2, that means for every $1 of earnings growth, I'm going to add $2 to your stock price. So I'm paying a lot for your earnings growth. Your earnings growth is valuable. If my PEG ratio is 0.5, that means I'm not willing to pay you a lot for your earnings growth. $1 of earnings is only worth 50 cents of value. So PEG is how do I value the growth. Now, if you think about it, the biggest driver of PEG is ROIC. Because if growth and ROIC drive value, and PEG says how much am I willing to pay for growth, why would I pay more for growth? Because go back to what we had talked about earlier this semester, if at the same level of earnings I generate more free cash flow, that makes me more valuable. How do I generate more free cash flow for the same earnings, it's because I have more ROIC. So PEG is probably the purest ratio at helping us understand the ROIC of the firm. Higher PEGs infer higher ROICs because I'm paying more for the growth, probably because they have more ROIC. Now, asterisk, they could be affected by some of those non-operating items. Okay, but generally, PEG is the most ROIC based. Ratio number 3, enterprise value to sales. If you grow sales $1, how much am I willing to pay for $1 of sales? Right? So enterprise value to sales. What am I willing to pay for the sales? Enterprise value to EBITDA. If you grow your EBITDA $1, how much am I willing to pay for the EBITDA? Again, price relative to the EBITDA. And then EV to EBIT. If you have $1 of EBIT, what am I willing to pay for that? Again, multiples. Finally, price to book. Book is book value of equity. So that's how much the shareholders actually gave you. Price is the market price of that equity. So a price to book of 1 would tell you what? The book value of equity equals the market price. What does that tell you? Think in terms of the drivers of multiples.
No growth.
Now, it could be growth. What else could it be? Doesn't tell you about the growth, but it does tell you about something else.
And mature company.
The spread. Price to book of 1 is what spread? Theoretically. It's a 0 spread. Regardless of the growth, you're worth exactly what you gave me. Right? So the value doesn't change as you grow. Because again, price to book of 1, I give you $1, you're worth $1. No NPV, no spread. Price to book above 1 infers a positive spread. Because you gave me $1, I can give you more than $1 back. I had positive NPV. I had positive spread. Price to book less than 1. I destroyed value. You gave me $1, I can't even give you back the money you gave me. Negative NPV, inferred negative spread over time. So price to book is another indicator of the spread of a company. So those are the 6 multiples that you're going to be responsible for calculating and understanding this semester. Yes?
They typically have fair value of an equity. Is there a certain one of those 6 multiples that is pretty standard to use?
Well, if you're saying fair value of equity, then that would be the price to book. Because the book says, I gave you a certain amount of equity, the book value, what is it worth? And if you're doing really well, the price to book should be high. And if you're not doing well, the price to book should be low. The one challenge with that ratio is accounting. Because the book value of equity is influenced by accounting. Because it's called the book value of equity. And the problem is, all those write down and adjustments, for example, the impairing goodwill that we mentioned earlier in class tonight. If you impair goodwill, guess what you do? You write off a bunch of equity. So you could actually distort the price to book ratio because of accounting adjustments. So that's the one challenge with price to book. Is every now and then you look at a price to book and you can't explain it. And the reason you can't explain it is 2008 defense and aerospace industry. You are going to see some crazy price to book ratios in this class. And that goes right back to 2008. And Lockheed Martin is an example. I know one of your companies is doing Lockheed Martin. They have a crazy price to book multiple. And the reason why is because in 2008, when the stock market crashed by like 35%, they have a bunch of pension assets. And those pension assets lost a ton of value. And because they do work with the government, and the government said you can't have unfunded pension assets, Lockheed Martin had to take a big write-down to basically cover the loss of all the value of the pension assets. So basically when the pension assets went down, they had to write off a bunch of equity. So Lockheed Martin has a distorted price to book ratio because they wiped out a lot of equity on paper because the value of their pension assets fell in 2008. Now what's ironic is the pension assets have recovered in the last 4 years. And they're probably worth more today than they were in 2008 when they wrote all these assets down. But here's the problem. The accountants won't let you write up the book value. So they can't book gains on these pension assets until they actually sell them. So, because they're invested in the market for the long term. So they have a distorted enterprise value and they have a distorted book value of equity because the enterprise value and the price is very high today because the assets have a lot of value, but the book value was wiped out 5 years ago. So again, you got to be careful when you look at this ratio because it's clean unless the accounting adjustments come in and make it unclean. And unfortunately, that's happening more and more. So price to book's a great ratio in theory, but in practice, with the adjustments, it can be misleading. Yes?
So if you want to adjust the market value of their pension assets, is that metric in the disclosed in the 10K? They just say, hey, by the way, we can't write it.
Yeah, but you got to look at the footnotes. So in the footnotes, they'll actually have, because the accounts will make them do this, in the deep buried in the footnotes, they'll have the pension assets and the pension liability value. And then they'll net them, and then the difference is whether or not they have a surplus or a deficit. And historically, most companies have run deficits, and they just assume we'll fund them later for future profits. But the challenge was that the government, particularly in the mid-2000s, started losing a lot of money when companies were going bankrupt, and the Pension Benefit Guarantee Corporation, or whatever, the government insurance body, was basically in a deficit because a few companies wiped out all their pensions. The airlines and the autos basically wiped out all of our insurance proceeds. So the U.S. government changed the laws and basically said you can't run a long-term deficit with your pension. And so now the accountants have gotten, as a result of that, much more aggressive, so that when you run a pension deficit, they actually make you fill it. And you can either fill it by writing off the equity, but ultimately you got to write cash checks to the assets to make up for it, which is the other way that Lockheed Martin did this. So in 2008, 2009, Lockheed Martin actually wrote a check for over $1 billion to fund its pension deficit, because the government said you couldn't have an unfunded deficit, and their pension assets they had to write down for a big loss against their equity. But ever since then, and most of the other defense and aerospace companies did something very similar to that. And you'll see that when you do your analysis, is your price to books will be distorted. And they're not going to make nearly as much sense as you probably would think in our simplistic analysis here, for that very reason. It goes back to the pension assets in 2008. Everybody had that problem that had pensions. So you go to a company that doesn't have a pension, like a Costco, their price to book is going to be clean because they never had pensions to write off pension assets. So they have a more clean price to book if we were to look at Costco's price to book. But you take a Northrop Grumman or General Dynamics or a Raytheon, theirs isn't going to be so clean. All right, so here's what we're going to need to do. How do we get this multiples data? Got to go to Bloomberg. And I'm going to use Nordstrom as our example. So the way to work is I either type in the company's name or ticker symbol. So I'll start typing in the name, Nordstrom, or JWN, which is their ticker symbol, and then it'll be U.S. equity. The section in Bloomberg that you will use to do multiples is called the RV section. It used to stand for relative valuation. They put it under the comparative analysis section. But you can either click on it or type RV when you get to the company. The advantage of the RV section of Bloomberg is it quickly allows you to compare a company against its peers against multiple metrics. Okay, so if you want to do comparisons across companies, the RV section is built for you. So I've already done Nordstrom's in a different class. So I'm going to go back to the comp source. And typically when you log into Bloomberg, it's going to give you the GICS comp source. I think it stands for the General Industry Classification Service. And these are basically the government classifications by sector, in this case the industry, multi-line retail. And over here you have region, country of domicile. Nordstrom is a U.S. company, so these are the U.S. companies in the GICS code that are coded for being peers of Nordstrom's. Now I could go down to the department store sub-industry, click on that, and it will shorten the list to the sub-industry for Nordstrom. Everybody see that? Now the other one that I would recommend using is there's something called the Bloomberg comps. And what the Bloomberg comps do is that somebody at Bloomberg has actually gone through the peer list and they have put together a list of who they think the likely peers are. So if you use GICS, then you're just using a standard classification. If you use Bloomberg peers, then you're actually using an edited list, right, where somebody has actually gone in who's a finance professional and said, I think that these are the actual comps to use. So for your purposes, I would actually recommend using the Bloomberg comps. Now you'll also notice that what Bloomberg has done in the Bloomberg comps is this is the whole firm, because Nordstrom's has a credit card, right? So they also have peers that offer consumer finance credit, which are a lot of banks, versus peers that are just department stores, which are peers that are the whole firm. So that's another example of why I say it gets very hard to do multiples, because you got a company that sells stuff in a store and they also have a credit card business that they're basically outsourcing to somebody else to run for them. But the idea is that, Toyota's the same way. You got Toyota and you got Toyota Finance, okay? And they're both part of Toyota, and our multiples are typically based on the company because the whole share price is based on the company share price, but your peers can actually vary by subsector. For our purposes, since this is a simple two-credit class, we're just going to do the whole firm to make it simple. Now, as part of your group project, you're going to have to pick 5 peers. So your company plus 5 peers. So from the Bloomberg list, and I would recommend not going outside the US for your peers, but you could choose foreign peers if you wanted. So for example, if I wanted to go to the global peer list, these would be the global peers of Nordstrom. But I think US is probably more realistic. Then down here, there's an edit comparables or edit comparables button. I click on edit. And what I can do is I can add or subtract peers. So let's say I wanted to get rid of Belk. So I uncheck Belk. And I'm going to get rid of Sears. I got Saks, JCPenney, Macy's, Dillard's, Kohl's, Sears. Let me get rid of Sears. I just want to use these 5 companies. Save. It says I have a custom set. Yes. And now I have my custom peer set. Or I could edit my list, and let's say I wanted to make down here Walmart a peer, it would add Walmart to my list. Okay. I don't really think Walmart and Nordstrom's are true peers in the retail market. I don't know, maybe you do. Because they do sell clothes at Walmart. But in any event, uncheck Walmart, save. They're now part of my list. Okay, so I have a custom list of comps. And you'll notice that Bloomberg has now changed this to a custom comp list instead of saying Bloomberg. And it's saved on my profile. So anytime I go back to Nordstrom, this list of peers will show up. Right? Questions about that? All right, so then I can use one of the comp sheets or one of these tabs to quickly do comparables. So for example, if I clicked on markets and I clicked on volatility, here's their volatility template. Here is their comp sheet, and I could do profitability. Here's their profitability template. They got a bunch of templates. What we're going to care about is custom. So you click on the custom tab. And the advantage of the custom tab is just that. I can choose my own custom ratios to quickly compare a bunch of companies. So for example, ROIC, based on the latest year. There's the ROIC for all those companies based on the latest year. Weighted average cost of capital. There's the weighted average cost of capital. Select stats. Market cap weighted average. There's the industry ROIC. There's the industry WACC. Right? We'd already talked about that in a previous class. Right? So now what I'm going to do is I'm going to do the same thing with multiples. So if I take one of these columns, I could delete the column. Delete the column. I'm going to get rid of the ticker. And I'm now going to start adding in my multiples fields. So as I said, there are 6 multiples that you need. Enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT are the first 3. So let's go back to the EV. What we care about is forward numbers. And what McKinsey talked about specifically is that the second forward year is the more normalized number. So sales 1 is first forward year of sales. So the first forward year. Sales 2 is the second forward year. So this year's sales, this year's estimated sales is sales 1 in Bloomberg speak. Next year's sales is sales 2 in Bloomberg speak. Okay, so Nordstrom has reported fiscal 2013 already. So fiscal 2014 for Nordstrom, which is January 2014, is this year's sales. And next year's sales in the Bloomberg world is fiscal 2015, which is January 2014. Or sorry, 2015. So here's the point. I start typing in enterprise value, EV, to sales. And you'll notice that there's an enterprise value to this year's estimated sales and an enterprise value to next year's estimated sales already in their database. So I take EV to this year's sales, I select it, I hit enter, and there's the enterprise value to the current year's EV sales 1. EV to sales, and I have EV to next year's estimated sales. That's sales 2. The next ratio is EV to EBITDA. So I start typing in EV to EBITDA, and I have EV to EBITDA this year estimated EBITDA, which is EV to EBITDA 1, EV to EBITDA, EV to next year EBITDA 2, EV, should I do it down here? EV to EBIT. Now it's showing me the EBITDA, so I'm going to show more matches. And I got EV to this year estimated EBIT. I'll select that. And then EV to EBIT. EV to next year's EBIT. And I'll select that. So there's my 3 enterprise value multiples already calculated for me using forward data that the database already has. Right? Next, price to earnings. P-E. And again, price to earnings for the next year and this year. So best PE for the best, by the way, BEST stands for Bloomberg estimate. Okay, so that's actually the consensus estimates. So the best for the current year is the forward year 1. The best PE P-E for next year would be forward year 2. So there's the forward PE 1 and 2. Okay. Next, price to book, P to B. There is only one, the current price to book multiple. And then finally the PEG, PEG. Oh, here, PEG. And we have the best PEG ratio. Again, I want the current year. PEG in Bloomberg is defined as the 5-year, it's based on the 5-year earnings per share growth rate. So it's called the long-term growth rate. So to help us figure out what's behind the PEG ratio, the last number I'm going to use is called the long-term growth rate, LTG. And the best estimated long-term growth rate is the 5-year growth rate in earnings per share that the analysts are using. So that's our proxy for growth in the multiples model. Okay, as opposed to using G in our model, which is growth in cash flow. The analysts use for multiples, they use growth in earnings per share. And we're going to say that they're somewhat correlated, though not necessarily identical. So here's the thing. I now have all my multiples. I have this little gear. Click on the little gear icon. I save as a new template. I call this 760 multiples. And I save my template. So now, anytime I come to this RV screen, I can click on my custom template and it will automatically calculate it for all of the peers. Questions about what I just did? All right, final steps. I then need to export the data. 2 ways to export it. Across the top, export, save screen as file, JWN-RV. So I took a screenshot of that screen, or output Excel. And then if I output to Excel, it will then take all of this data and it will dump it to Excel. Security warning. Yes, it's okay. The data has now been exported. Select, copy, because these are not numbers, by the way. These are database lookups. Paste special values. And just so it's a little bit easier to see, I'm going to make all of these 2 decimal places. And then basically file, save as an Excel workbook. JWN multiples. So I can either export as a screenshot or I can export it to Excel. All right, and that's how we get the data. So here's what I'm going to do. I'm going to go to Canvas. I'm going to go to our class website. The Files section. I already have a folder called Nordstrom where I had put the exported financial data for Nordstrom, the income statement, the balance sheet, the cash flow, and I'm going to add in the multiples data that I just downloaded. Here is the RV data, and here is the multiples spreadsheet. And then the last thing I'm going to do is I'm going to need 3 other screenshots to do a final valuation of Nordstrom in Bloomberg. Screenshots are the DES screen, because this is going to get me the current shares outstanding for the company, and I'll need the shares outstanding to value the company. So I'll save this screen as JWN-DES. And I'm putting the -DES or -RV so you know which screen to use in Bloomberg if you do this again yourself, which you will have to do. Next, I will do the WACC, WACC. Here's the weighted average cost of capital we use to discount the cash flows. So here is my JWN WACC. And finally, EEO, which is my earning estimate overview. Very important, I switched to the annual data. Here's the annual data. By the way, here's the same multiples we just spit out on the spreadsheet, calculated here at the bottom of the EEO screen, except these are only for that one company. So that's the advantage, by the way, using the RV screen, is I can actually look at multiples across multiple companies as opposed to going screen by screen for each company. But again, I will output this JWN-EEO. And then what I'm going to do is take these screen captures and put those in the Nordstrom folder as well. So there's the EEO, there's the WACC, and there's the description. And I think I'd already put in the RV and the multiple spreadsheet. So what we're going to do now is we're going to take a break.